Hi, it's Michael Farr from Farr, Miller and Washington. Markets continue to hold up well. We've seen new highs being made, but we've seen a little bit of added volatility. Greece continues to be a problem. The Federal Reserve has said that they're going to hold off, most likely, for this June meeting, but they continue to be kind of sanguine about a rate hike later this year. We're not sure that they're going to do it. We think a lot of the data continue to look weak, but we'll see if they actually mean it. This week, we looked over the past 15 or 20 years at what the Fed has done when we've seen asset bubbles and when we've thought that perhaps the Fed has exacerbated those asset bubbles and could have done more to thwart them. Moreover, we find that the indicators for those bubbles and the indicators for probably more urgent Fed action were there, probably not seen the way we have been seeing them, and could have been, I think a lot of the asset bubbles could have been thwarted better than they were, wouldn't have been created as great as they became had the Fed looked at things a bit differently. So, in this week's market commentary that we're sending out to all of our subscribers, which is free, you can get it at farmiller.com, subscribe for free. What we show is what I'm showing on this chart on my screen. The CPI versus an adjusted CPI. When we take a look at the consumer price index, it really doesn't include housing costs for home ownership, and it doesn't include the costs for retirement savings. With lower returns on retirement savings, you have to save more. So we know that most Americans are well undersaved for retirement, and as they have to save more, they are spending less out in the economy and they are fueling demand at a reduced rate. So we take a look at our adjusted CPI, which we explain, and we think that it's suggesting to the Fed right now that they should be putting the brakes on sooner. We doubt that they're going to do it. We doubt that they're going to actually increase rates much, even in September or October. We're crossing our fingers. Our data show that they should be doing something now. They should get out of the way, and we don't think it's healthy that they try and manipulate asset prices. During these sorts of periods, where there is a fair amount that is unknown and volatility continues, we think you should be conservative. We think that you should be defensive. This is not a time for investors to be aggressive. Stay out of the thin branches and make sure that you have a seat when the music stops. If we can help you at all, give us a call or send us a note at Farr, Miller in Washington. Thanks for tuning in again this week. See you next week in Washington, D.C. I'm Michael Farr.